ASML may be one of the best companies we can buy, but that is not the same as the best investment we can make. Why? Well, even if the company is great, we have to consider the price. Believing that there is no such thing as a price too high led to some of the most spectacular crashes like the Nifty 50 or the dot-com bubble. But the price of ASML went down by 32% from its peak. So let's analyze it and see how good it really is, and then let's value it and see, is it an interesting investment opportunity at the current time? So first, what is ASML? It is a Dutch corporation which makes machines which are used to produce computer chips. It is the largest supplier for semiconductor industry and the only supplier in the world of machines that are required to manufacture the most advanced chips. So all the main players in the semiconductor industry like Intel, TSMC or Samsung buy their most advanced equipment from ASML and only from them. They are basically a monopoly. And that's not a bad place to be for a company. So let's see how well they did in the past. If you were to invest $1,000 into ASML 10 years ago, you could buy around 10 shares. And today, they would be worth something close to $5,871. But let's not forget about the dividends. Through the 10 years, you would receive around $276 as dividends. So if we add the current value of shares and the dividends, we get $6,147. So that is a gain of 514% in 10 years. That is quite impressive. But can they repeat such results? Well, let's analyze this company and find out. Individual insiders, that is an X. 0.03% of the company is owned by individual insiders. And we would like to see this number over 2% because then we would know that the management is going to take good care of the shareholders because they are the shareholders. Unfortunately, it is not the case here. And are individual insiders buying? That is an X. We see only sale transactions in the last year. So maybe some super investors own this company. That is a check with 6 super investors. And if we would consider cloning their investments, we should know if they are buying right now. And that is a check. In the last quarter, super investors bought 143,000 shares and sold only 2,940 shares. So at least some of them believe that the current lower price is a good investment opportunity. Return on invested capital, that is a check at 16.6% 10-year median returns. And we want to see this number higher than 10%. So that is good. It tells us that the management is doing a very nice job. And what do we know about the free cash flow growth? It is a check at 27% 10-year compound annual growth rate. And also here, we want to see this number over 10%, so that is absolutely a great result. So let's take a look at the net profit margin. It is a check at 25.7% 5-year average net margin. And the industry average is 22.3%. So they are using their extremely strong position in the market in a very nice way. And what about share buybacks? It is a check with 8.1% of shares bought back in the last 10 years. That is another good news because all long-term investors became owners of a bigger portion of this company without spending any extra cash. And let's take a look at the debt. It is a check. It would take just half a year to pay the long-term debt with a current free cash flow. These results are great. We can see that it is really an exceptional business. But maybe there is more. The dividend yield is 1.3%, so in the last 12 months, shareholders got $7.69 per every share through dividends. That is not an incredible yield, but if we consider the share buybacks and the growth of the company, it is more like a cherry on top. And let's take a look at the payout ratio. That is a check at 24.4%. And we want to see it somewhere between 20 and 50%, so that is very nice. We get over 24% of the earnings through dividends. And what do we know about the dividend growth? It is a check with 29.9% 5-year growth rate. And it is not a very stable growth, as you can see, but in the long term, it is growing. Price to earnings ratio is 29.2, so that is quite high. What it basically means is that for every dollar this company earns currently, we have to pay $29.20. That is rather a lot. But to properly value ASML, we will have to estimate its growth for the next 10 years, and we will make 3 scenarios of this growth. So in the low scenario, we will estimate a growth of 8% for the first 5 years and then 5%. In the medium, 10% and then 8%. And in the high scenario, 13% for the first 5 years and then 10% growth. Now, why did I use such estimates? Well, if we look at the 10-year annual growth rates, we see that the revenue went up by 13.7%, free cash flow went up by 27%, and earnings per share went up by 15.6%. So I'm keeping my estimates below the past results. And some analysts predict a growth of 23% for the first 5 years and then 33%. And of course, they may be right, but honestly, that seems a little bit like wishful thinking. I understand that it is a key sector in the world economy and that it is going to grow. But to grow twice as fast as it does today is, well, unlikely in my opinion. But of course, tell me in the comments if you have a different view. I always find your remarks very valuable. So, with such estimates, the intrinsic value in the low scenario is $353, in the medium scenario $419, and in the high scenario $503. But these are not the prices we should be looking for, because we have to always add a margin of safety. I use a 30% one to give me a sufficient room for mistakes. Basically, my estimates may turn out to be too optimistic, but if I have a large enough margin of safety, the punishment for such a mistake should be much smaller. So, with a margin of safety, we get in the low scenario $247, in the medium $293, and in the high one $352. And the current price is around $586. So it is all in the red, which means that this company is currently rather expensive. ASML is definitely a great company. Growth, margins, share buybacks, debt, it is all great. Unfortunately, the price seems to be quite high. And even though I would love to own this company, right now it does not seem like a great investment. When we have a decent company that is overpriced, it is easy to just forget about it and move on. But when we are faced with a real gem that is overpriced, it is much harder. Thanks for watching and see you in the next one.